Welcome back to Property Matters here on Dublin South FM with myself, Carol Tallon. You can contact us on social media at iPropertyRadio or email hello@iPropertyRadio.com. So we're now joined by Rupert Hogan of BusinessLoans.ie. Rupert, you're very welcome. Most people in the industry will be familiar with business loans. You know, you've got a strong social media presence, but they might not be familiar maybe with all the facets of the business. So you're very welcome today.
Well, Carol, thank you so much for having me on, and it's a pleasure to be here today.
Thanks, Rupert. So look, as mentioned, your business, very aptly named BusinessLoans.ie, but actually the breakdown of what you do is quite varied. So you established the business in 2018. You might just talk us through some of the core offerings and the ones that are, you know, particularly relevant in the current marketplace.
Well, that's it, Carol. I started at the business. My background was I was working for a peer-to-peer lending company, and I was dealing with construction companies and working capital for everyday plumbers and electricians and carpenters and so on and so forth. But at the time, I started realizing there's so many more alternative finance options on the market that can help business owners. So maybe their accounts aren't strong. Sometimes they might have assets, they might have other secured lending needs, and I was able to cover a broader spectrum of the market with BusinessLoans.ie. So I bought the domain and I started working hard on social media to build the brand. And obviously we're interacting a lot and crossing paths because I'm very much interested in the property market as well.
Oh, very good. Well, look, talk us through some of the categories of lending that you have, you know. So for example, I was on your website. I see, you know, there's working capital for construction companies. The figures on the website are between 100k to 5 million, but I know you also offer development loans of up to 10 million. So you might just talk us through some of the different categories of lending there.
Well, agreed. So to start off at the most basic level, what's hot in the market right now is the COVID-19 credit guarantee scheme. This still runs up until the end of the year, and everyday construction company owners can get access to working capital up to 250,000 unsecured without a personal guarantee and no early repayment penalty. So it's a very good deal up until the end of the year. They might extend it again, maybe they won't. But generally, the business has been affected by COVID, and in construction, you can be pretty sure you have been. And your business is still probably showing a profit to get an unsecured loan. So you haven't filed at a loss for 2020. And if that's the case, there's a reasonable chance you could have success in getting working capital for your ongoing projects as well.
Okay. So, but sorry, just before we expand on the next one, just in terms of the credit guarantee loan, some of the feedback I've gotten from some of the smaller players is that there's an expectation they won't get it. Maybe they're not confident in the state of their accounts, but they're also a little bit skeptical, as in they don't understand what the catch is. So, for example, we saw people who relied on wage subsidies being audited afterwards and payouts seen you know, awards that were made in good faith then seen not to be the case and repayments required. So actually I've started to see a lot of skepticism within this industry about the loans. Is that something you're coming up against?
Well, that's a good question, Carol, because I guess some of the feedback I'm getting is very similar, and that's people dealing with the pillar banks. Now, the SBCI has disseminated money throughout the non-bank lenders who are much easier to deal with, and they are used to people being on wage subsidies. But the key question is the business in profit? Is there any recent mispayments? Once those bridges are crossed, there should be no problem in getting credit guarantee scheme funds for any of these companies. So if I was to speak with them, I can generally just look at a recent set of accounts, a few months bank statements, and very quickly you're able to tell if it's going to be a likely pass or not. However, you're very correct in saying that if you've been dealing with pillar banks, they often request reams of documents. So every credit team has their own approvals process. Some are easier to deal with than others. So that's why I'm focused mostly on non-bank lenders, and they are certainly knocking out quotes day after day for me at the moment.
Okay, will you just, apologies now if I'm misunderstanding this or not getting to grasp it, but will you just explain your role in the transaction? So where do you sit in terms of finding the financing? Are you a broker?
Exactly. So I organize the loan quotes like a broker. I have a in-depth understanding and good relationship with various credit teams. I literally deal with about 60 different credit teams, and I know them all on first name basis. So as soon as I speak to a business owner, I can have a general conversation. Very quickly, I can ascertain the most likely place where they're going to get funding. Now, if the accounts are showing a loss or something's gone wrong, a lot of these construction companies own a lot of assets. Now, the credit guarantee scheme has asset finance, but you can also use those assets and refinance them and get working capital under the credit guarantee scheme through asset finance lenders. So it all depends if your accounts are strong, if they're weak. There are certainly options out there. There's also invoice finance. So if you're a contractor, there's credit guarantee scheme funds with invoice finance companies. So there's a broad spectrum of different types of finance depending on the state of your accounts. But generally, the feedback is from pillar banks, they're always harder to deal with. They'll be looking for business plans and cash flow forecasts and reams of documents that would be frustrating for any business to get at the moment.
You mentioned there that figure stuck in my head. You might be working with up to 60 credit teams. Will you give just a bit of an overview to, I suppose, of the non-bank lending ecosystem in Ireland? Because actually, I don't think it's something that's very clearly laid out.
Oh, it's not. It's as a business owner, you get on Google and next thing you're going to see is the ads, and you're all getting directed towards the usual players in the market. So when you dig a little bit deeper, there are many different lenders. So starting off, if your accounts are in profit, you've been around maybe a year or 2 years, unsecured lending is very straightforward. If your accounts after coming through COVID are a bit weaker, you could be looking at secured lending. So that could be taking all those assets you've used working capital to buy over the years and extracting working capital out of them to use for your ongoing projects. So asset finance lenders also can get you new assets. So that means hire purchase or leasing, which can have tax deductible benefits, and you can get used machines from dealers in the south or in the north. It doesn't have to be brand new stuff. Ongoing projects, you might need to be able to cash in your invoices earlier and extract working capital. So you might get most of the value of that invoice somebody owes you. You're not going to get paid for a month or two. You can get that cash today using invoice finance. And there's flexible invoice finance on the market. It's not that old stuff in the past where you're locked into these agreements for years and you could never feel like you can get out from under it. You can literally cash in on an ad hoc basis invoices today. Other than that, then there's a lot of different options for development finance. So some business owners in construction, they might have rental properties. It's very easy to use them from amounts from 150,000 euros and upwards for that level of loan to extract value from rental properties. The reason I say rental properties is often people would try to use a personal home or suggest that, but it's really down to commercial properties, industrial properties, rentals and that kind of thing. And then there's development finance from 250,000 and upwards as well. So there's lower end deals in the market. The pillar banks are generally only interested in the multi-million deals, as we all know. So it's for the general average micro business or SME, there are lower end deals on the market as well.
I saw on your website that your focus is SME lending. And before we came on air, I mentioned to you that in a recent interview on air with PJ Rudden, who's the government appointed chair of the construction sector group with a focus on innovation and digital adoption, he was talking about how 95% of the industry is made up of SMEs. And I was blown away by that figure because I suppose I, like a lot of people, were thinking of the larger players in the industry, and in number of business terms, I wouldn't have thought they were only 5%. So apparently this is an industry that is made up of 95% SMEs. How do you access those? Because one of the issues we discussed in a previous interview was that they're quite a disparate group. They're spread all over. So it might be electricians, it might be plumbers, it might be, all different manner of businesses providing into the industry. How do you gain access to those, or are you primarily dealing with maybe the smaller home builders or main contractors?
Well, that's a good question, Carol. Like at the moment, we're open for business for any, like whether you're labeled as a builder or construction or electrician. The primary thing that we're looking for is sole traders or limited companies. And so long as whatever trade or business that they're in, it doesn't really matter to us. The key question is, have they come through COVID in a way that they still have access to debt finance? Now, a lot of the time when we speak to people, they've already been to their bank and they might be getting the slow no, or they're not getting a decision in a timely fashion. And these people have wages to pay, they have projects to pursue. So it doesn't matter to us if somebody is an engineer, a plumber, a tiler, or anything like that. The key question is, do they have the right documents that they can provide to us? Now, at the moment, some people who are a sole trader, they might not have that latest set of accounts ready just now, or there's been automatic extensions on 2020. So people are having real difficulty getting documents out of their accountants at the moment. The accountants have priorities to do with COVID-related matters, and it's a real issue at the moment with revenue and tax clearance certs. So I can appreciate that some customers feel that they might not have access to finance, but if you drill a little bit deeper and if they engage with BusinessLoans.ie, we could narrow it down quite quickly. It could be invoice finance if your accounts are showing a slight loss this year. There could be access to asset finance. And generally, we just have that conversation with them and narrow it down from there. But certainly, it doesn't matter what area of the SME or micro business market that they're in, and there's certainly are options from alternative lenders out there at the moment.
Okay, can you share with us where your funding comes from? Who are your funding partners?
I certainly can. So usually my starting point at the moment is with peer-to-peer lenders. Now, some of these lenders traditionally have relied on crowdfunding. So every person in this country, if they wanted to, could contribute funds into a business loan and avoid negative interest rates with the banks. Depending on what your risk appetite is, these credit teams will put up a risk profile and an interest rate, and people can contribute funds. Now, some of these lenders have got funds from the SBCI now, where they have cheaper funds available from the government, and there's no personal guarantees. So most of these lenders have multiple streams of income. Sometimes they're backed by hedge funds as well. So they have, depending on the borrower, they can contribute funds from a variety of different sources. Most of the time, these credit teams are just looking at simple accounts, bank statements, tax clearance certificates. However, that would be the starting point, generally peer-to-peer lenders. On the other spectrum, we have the invoice finance lenders like Grenke and Bibi Financial and so on and so forth. So they support a lot of construction companies, especially if they're subcontractors or anybody who's raising invoices and dealing with a business client. The key question is, what are the quality of the people you're doing business with? Can the lender get credit insurance on the person that owes you money? And that's a key test. If you're dealing with quality clients and they can get credit insurance, you can cash in those invoices all day long. Other than that, then there are non-bank asset finance lenders. So that's like your Close Brothers, Capital Flow, SME Finance and Leasing down in Kilkenny. So there's a few of these non-bank lenders, and many of these now have access to government funds for a while. So up to $1 million, no personal guarantees, and lower rates at the moment as well.
Okay, you mentioned lower rates.
Okay. So all the asset finance lenders, such as your Capital Flows, your Close Brothers, your SME Finance and Leasing, they all have access to SBCI funds at the moment. So some of these don't even require you to come up with any deposit for your hire purchase or leasing. There's competitive rates, and you can source new or used items. So before Brexit, a lot of people would get higher spec vans and machines from the UK, but it's much more difficult now. However, dealers in the north are easier to deal with. So there's a big increase in business there for getting new and used machines, even things that are maybe 8 or 9 years old.
Okay, you mentioned there competitive rates. We know that, and obviously negative interest rates on the consumer side at the moment. In terms of interest rates, non-bank lending has traditionally attracted significantly higher interest rates. So how is that remaining competitive, even though we're in a low interest rate environment?
Well, yeah, I agree that the rates traditionally have been a bit higher with non-bank lending. I would say one thing about that though. when you factor in for a smaller loan the amount of documents that you're expected to produce and get your, the expense that you need to go and get your accountant to produce reams of documents, it can quickly add up. And also when you put a value on your time, I think the average business owner can put in about 15 hours of their time into a bank loan application. So there's a couple of things about non-bank finance that maybe the rate might be a point or two higher sometimes, but the stress level and reams of requests are much lower. But to give you an idea of figures at the moment, with the SBCI non-bank lending for unsecured finance, it starts at maybe 4.75% for maybe an A grade 12-month loan, and the risk profiles can make it higher, or the longer the terms, like if you're getting out to 4 or 5 years terms, it can be a bit higher as well. But generally it's thereabouts, and these things can be fixed up early as well. Like if you do come across cheaper finance elsewhere, you could certainly fix it up at any point, penalty free.
Okay, thanks, Rupert. One of the things I'm very aware of is that you and your team are speaking directly to construction SMEs at the moment. We hear a certain amount feeding back, and certainly it's covered in the media about ongoing issues at the moment. So whether they're COVID delays, labour shortages, rising construction costs, delays, shortage of supplies, even at increased costs. So talk to me about the issues on the ground that maybe your clients or applicants are talking to you about.
Yeah, well, very good question there, especially people supplying to the construction trade. The prices are going up, the shipping costs, across the board, inflation seeping in. So what a lot of people have to do is make bigger orders. So they might have to pay for a full shipping container of product. And then when it comes, all these costs are passed on to the construction companies. Their lines of credit have dried up as well. So they used to be able to rely on their suppliers for a decent line of credit. And now a lot of them are expected to front up the cash up front. So this eats into their working capital, and generally that's when I end up speaking to them, because they're starting to eat too much into their overdraft, and they're starting to get worried about making the wage bills and so on and so forth. So the key thing is it's best to get access to finance before things start going wrong. And once you start missing direct debits and standing orders, that's when things start going wrong. So it's always better to be overcapitalized than undercapitalized. And in that situation, any of these SMEs, they just need to get their quotes before things start stacking up.
Okay, I'm really curious about the SME sentiment out there within the industry, but I'm also aware that anybody speaking to you is going to be extremely optimistic about the future, because that's what's required in the process of a loan application. But in terms of sentiment, are you picking up on how the industry has fared over the past 18 months, and how, I suppose, optimistic they are about the next 12 months?
Yes. I on the worst end of the scale, I've spoke to people who've been involved in house builds, and those people who were supposed to be paying for these house builds became unemployed because of COVID, or things went wrong in their personal life, and through no fault of their own, and they were unable to continue with the build, whereas the builder was significantly invested. So there are those situations that I have dealt with where the accounts have gone so bad that it's really into this stage, and where these are a zombie business, or they might have gone back to being a sole trader, or they're working in some other area where businesses have gone wrong. And in those situations, sometimes it is time to speak to an insolvency practitioner, or their own accountant is always the best starting point to see, is that business actually still viable where things have gone so wrong. But if the business has invested in assets over the years, they've laid out cash, or if the business is just about breaking even, there are certainly finance options from debt funding still available.
That feels like a difficult conversation to have with a company, I would imagine, who was approaching you looking for finance, and you're telling them that maybe finance isn't the right option, that perhaps speaking to an insolvency practitioner, that seems like a difficult conversation to have. I mean, would it be the situation that business owners would be coming to you in that kind of state?
Well, yeah, sometimes the first port of call that is to actually seek more finance, but debt financing is not always the best answer. Is the underlying business still viable is a key question. Now, any business owner in that situation has access to their local enterprise office, and there is mentors and there is free advice available. So just put into Google the local enterprise office, and there are professionals available, or an accountant is usually the person who can tell you how strong your accounts are and if they're viable going forward. But a lot of businesses in construction have come through the other side and they're booming again, and there are certainly finance options that are available. Maybe not the traditional bank loan, it could be the something that's a bit more secured, and then they can come back to market when the cash flow improves.
That's an absolutely great point about reaching out to the local enterprise offices, because we know that that's something this industry doesn't do, even though they are SMEs and those services are already in place and funded by government to be handed out to SMEs. The industry just bypasses them altogether, right across the country. It's something that has been discussed at local enterprise level, and it's been recognised as an issue. So that's a really good point, actually. And I hope anybody listening in that feels in need of support actually reach out to their local enterprise office and access those supports, because again, they've already been allocated by government. They're already there and they're available, and funding has already been made available and resourced. So that's a really great point. Rupert, before we finish up, what is your call out to the industry? What does the industry really need to know about accessing finance in the current market?
Well, I would say the banking industry as a whole needs to understand that most of the business owners that they're dealing with are micro businesses. They are managing the marketing, the sales, the HR, and they don't have time to request all these documents. Now, lending decisions can be made on a few very simple documents. And I think the industry needs to be more forgiving to people in construction. The industry's picking up at the moment. It's getting back on its feet, and they need to be funneling more working capital in an easier fashion through to SMEs.
See, what I heard you say there is they need a little bit more humanity.
I agree.
Okay.
I agree.
Thank you. Thank you. That was Rupert Hogan of BusinessLoans.ie. And that's it from us this week. Thank you for listening to Property Matters on Dublin South FM. You can get in touch with the show on social media at iPropertyRadio, or email hello@iPropertyRadio.com. My thanks to Peter Rice on sound. We're back at the same time next week. From myself and all the team here, stay safe.